Modern portfolio theory basically states when you're putting together a portfolio of assets, and if the asset returns have low, no, or negative correlation amongst the other assets that are in the portfolio, you're going to get diversification. And if you get low, no, or negative correlation in the returns, as you add those assets to the portfolio, it's going to lower the overall risk within the portfolio. And modern portfolio theory basically states, the way that the model is laid out, is you start with the expected return on the portfolio. And you have the standard deviation of the portfolio. From the origin of the y-axis is what is called the capital allocation line, or the CAL. Then there's what is called the efficient frontier that emanates out from the capital allocation line. You can build a portfolio of 100% stock. And obviously with 100% stock, there's going to be high risk within the portfolio, but you're also going to expect a higher return. You can also build a portfolio of 100% bonds. Now, obviously, you're going to get lower expected return on that portfolio, but you're also going to get significantly less risk within the portfolio. The tangency between the efficient frontier, and again, these are all the feasible portfolios.
What is it? The efficient frontier?
This is the efficient frontier, and this is the capital allocation line. And basically, there are portfolios in and on the efficient frontier that are potential combinations of portfolios that you can construct from assets that are in the marketplace. So these are feasible portfolios that you can construct. The point here at which the portfolio, the efficient frontier, is tangent to the capital allocation line. And you also have tangency, what is also called utility curves. Now, risk-averse investors, which you are, would love to be up here, wouldn't you? Wouldn't you love to get high return and low risk? But there's no assets in the marketplace that provides high return and low risk. You have to be compensated for the return. You have to take on more risk to get more return. So what risk-averse investors have to do is they have to lower their utility to get to the point where the utility curve is tangent to the capital allocation line and the efficient frontier. At that point, you have what is called the market basket. And at that point, your portfolio standard deviation is at its lowest, and your expected return is at its highest. So therefore, at this tangency point, and I'll give you an example of a model portfolio, the risk-adjusted rates of return are maximized. Now, most investors want an 8 to 10% rate of return. Why would investors want an 8 to 10% rate of return? Do you know?
The market does.
That's what the market does, but under the rule of 72, if If you can get an 8 to 10% rate of return on your portfolio, every single,
Double your money.
it doubles your money in less than 10 years. Are you better off? Yeah. So everybody, okay, that's risk averse, institutions and yourself, everybody is targeting an 8 to 10% rate of return because they can double their money in less than 10 years. So that makes the expected return variable a constant. So if you can add assets to your stock bond portfolio whose returns have low, no, or negative correlation with stocks and bonds, you can reduce the portfolio standard deviation and increase the risk-adjusted rates of return. That's the goal. That's the objective. If you can do that, there will be millions and billions and trillions of dollars that will flow to your company.
Is that a formula right there, the 8
Yes.
to 10% divided by the
Yeah.
estimated rate? Is that what that is?
The expected return on the portfolio is 8 to 10% return.
But that's a
The
division.
expected return divided by the standard
Okay.
deviation of the portfolio is the equation which gives you the risk-adjusted rate of return.
So you're saying basically the theory is to balance out high risk and low risk, so that the risk.
You want to be compensated for the return. But the goal is all investors, the majority of the investors out there, want an 8 to 10% rate of return. So that makes the expected return on the portfolio a constant. So if becomes a constant, then the goal is to reduce the portfolio standard deviation through diversification. That will increase the risk-adjusted rates of return.
So what's the lowest and highest standard deviation?
Well, the stock market volatility could be 25 to 50%. Different stocks, large cap stocks, medium cap stocks, small cap stocks, technology stocks, consumer stocks, real estate, office buildings, industrial, everybody's got a different portfolio standard deviation.
So we're trying to control the denominator, right?
Numerator is fixed. Everybody wants an 8 to 10% rate of return. So what you try to do is to build a portfolio and add assets to your portfolio whose returns have low, no, or negative correlation with stocks and bonds. And I'll go through what those assets are. So let's go through some of the mechanics. Let's stress test the model. Can I move up the efficient frontier as an investor? Can I move up the efficient frontier?
Yeah,
Yeah.
for your risk,
So what am I doing?
increasing your risk.
By doing what?
Increase the
Yeah,
denominator.
how am I if I'm getting to a 100% stock portfolio, what am I doing? What's the strategy?
Buy more stock,
Increase the risk.
lower,
I'm lower.
buy more stock, lower the
Increase
bond.
expected
That's right.
return.
Buy more stocks, sell off your bonds. Okay? I'm willing to take I want higher return, but I'm willing to take on more risk. Okay? Can I move down the efficient frontier?
Mhm.
Yeah, and what am I doing if I'm moving down the efficient frontier?
Taking on less
Sell,
risk.
sell off stock, buy more bonds.
I'm selling stock and buying bonds. I want a lower rate of return, but usually what I want is lower risk, and I'm willing to take a lower rate of return. Here I want higher return, and I'm willing to take on more risk. Yes, sir.
We are reducing that standard deviation by coming to left,
That's correct.
and if we reduce the denominator, so the denominator will be reduced, am I right?
Yes.
So the max risk will be increased, but
No, risk is actually in the portfolio is being reduced, and I'm also getting a reduced
so
rate of return.
this one is the sign of the risk. I mean,
This is the risk. This is the
Oh,
risk in the
because-
portfolio. This is the return of the portfolio.
because on that equation, the
This is the
risk
expected return on the portfolio. This is the portfolio standard deviation. This is the risk of the portfolio.
will result in the risk.
This is
That
the
one?
risk of the portfolio, the volatility of the returns in the portfolio. This is the standard deviation or the risk within the portfolio. Okay? If I'm locking in an 8 to 10% rate of return, and I'm trying to get a higher risk-adjusted rate of return, I gotta lower the risk within my portfolio. How do I do that? I add assets into my portfolio whose returns have low, no, or negative correlation with stocks and bonds, and I'll get to that in a minute. Okay, any other questions?
Okay, so
if I'm in this side,
You're moving higher return, higher risk. Lower return, lower risk. Okay?
and in this case I buy,
Buy stocks, sell bonds.
okay.
Buy bonds, sell stocks. Okay?
However, in the other side, I'm gonna go like buy stocks, sell bonds.
Buy box, sell stocks,
Yeah,
sell
the
bonds,
other ones.
buy bonds, sell stocks.
stocks.
That's right. So you're just, what you're doing is you're changing the allocation of the portfolio until you go to 100% stock and 100% bonds.
Okay, so in this side, I buy bonds and sell
Yep.
stock?
Sell bonds, buy stock.
Okay.
Okay? I can also jump off the efficient frontier through the use of leverage. I can use margin accounts, or I can use mortgage for real estate. I'm using borrowed money to lever up my equity. I'm gonna get a higher rate of return, but I'm taking on significant more risk by using leverage in the portfolio. I can also jump off the efficient frontier and move down the capital allocation line through the process of lending, which is what banks do. So through the process of lending, I'm gonna reduce my expected return, but I'm gonna reduce the portfolio standard deviation of the risk significantly. So through the use of leverage, I can jump off the efficient frontier onto the capital allocation line, move up, get a higher rate of return, but significantly higher risk. Through the process of lending, I can jump off the efficient frontier, move down the capital allocation line,
But I will be.
but I'm gonna get significantly lower return, but significantly lower risk. Okay? So here's the key here. Here's the key. If I can add an asset to a stock bond portfolio whose return has no low or negative correlation in stock bond returns, what it's gonna do is it's gonna bow out the efficient frontier. This is the key to the whole lecture, right here. Is it will bow out the efficient frontier. So what it'll do is it will reduce the expected return on the portfolio. But what it does is it reduces the portfolio standard deviation significantly more. So if I can get my 8 to 10% rate of return locked in, and I can add assets to my stock bond portfolio with no low or negative correlation, I will get lower expected return on the portfolio, but I will get significantly lower risk in standard deviation in the portfolio. So yes, my expected return will go down, but my portfolio standard deviation will go down even more. And my risk-adjusted rates of return will go up significantly, and risk-averse investors or institutional investors are better off. So what are some of the assets, the asset classes that have low, no, or negative correlation in their rates of return with stocks and bonds? So the first one is going to be, and I think I'm okay over here, is going to be cash value life insurance. Cash value life insurance, the dividends and the returns have no correlation whatsoever with stocks and bonds, really. So they have no low or negative correlation in the returns to stocks and bonds. So if you add cash value life insurance to your stock bond portfolio, it will bow out the efficient frontier. Also, if you add private equity real estate to your stock bond portfolio, private equity real estate has low, no, or negative correlation in their rates of return with stock bond rates of return. So they will also bow out the efficient frontier. And then the last one is alternative renewable energy assets. Long lives, tied to commodities, alternative renewable energy assets. Their rates of return have low, no, or negative correlation with stocks and bonds. So if you add them to your stock bond portfolio, it bows out the efficient frontier. So if you look at the research that's been done, cash value life insurance, Ibbotson and Associates, did the research, did the portfolio analytics, and came up with a 10% allocation to cash value life insurance within your portfolio. That was the recommendation. And these asset classes here are also called alternative. Also called alternative asset classes. Ibbotson and Associates, also in the 80s, did the research and came up with, did the analytics and came up with the recommendation for a 10% allocation to private equity real estate. And under your ERISA, that was passed in the 70s and early 80s, that basically required pension funds to have at least 10% allocation of their assets in real estate, also institutionalized and legitimized the allocation. Then Deutsche Bank, DB Reef, about 7, 8, maybe 9 years ago, did the research, did the portfolio analytics, and came up with a 10% allocation to alternative renewable energy assets. Would you believe that there's going to be more volatility in the bond market because of rising interest rates? So has there been more volatility in the bond market over the last 2 years? Yeah, because interest rates have gone down, bond prices have gone up. Now interest rates are going up and bond prices are going down. So there's more volatility, right? Okay, so you would probably want to reallocate out of bonds, right? If there's more volatility in the bond market, do you want to stay in the bond market?
No.
No, because it's more risky, okay? And has the stock market become more volatile over the last maybe 10, 15 years?
Yes.
2003, 2008, 9, 2010, 11, 12, 13. So lots of volatility in the stock market. So would you want to reallocate some of your allocations away from the stock market? Yes, probably. So the model or the target is the model portfolio or the market portfolio. Recommendation based on low, no negative correlation amongst these alternative assets and increased volatility and risk in the stock and the bond market. The reallocation and the target model portfolio for the next 30 years for institutional investors, risk-averse investors, is going to be 40% bonds, 30% stock, 10% cash value life insurance, and actually banks like Goldman Sachs and B of A and Wells Fargo put cash value life insurance policies on their senior executives. And the cash value in those policies are considered tier 1 liquid capital. It's one of the safest tiers of capital for the bank, and nobody ever talks about it. And it's called bank-owned life insurance, or BOLI. So it's already institutionalized. And then the private equity real estate has been completely institutionalized. And alternative renewable energy is in the process of being capitalized and institutionalized as we speak, and will probably take another 20, 30 years to have publicly traded and private companies and funds that are available for retail investors like yourself and institutional investors to be able to get allocations in this asset class. So if you take on this portfolio allocation, it is going to bow out the efficient frontier. you will get your 8 to 10% expected return on the portfolio. It will reduce the portfolio standard deviation significantly, and the risk-adjusted rate of return on the portfolio will be significantly high, and that will meet the requirements of risk-averse and institutional investors. Okay, do you have any questions? That's basically the model. Go ahead.
The model target, is that Ibison's association model target, or it's just written there?
Ibbotson did the research and legitimized the 10%. Ibbotson did the research and legitimized the 10% for private equity real estate. Deutsche Bank Reef did the research and legitimized the allocation to alternative renewable energy.
Okay, but it's not their model, that's separate.
They did these analytics, and came up with these allocations.
So whose model target is that?
Mine.
Oh, okay. All right,
No, it's mine.
all right.
Okay. But it's been validated and verified through the external research with these allocations. I didn't make these up. I, did the meta research, found the research reports, put these together, and then said, okay, well, we're gonna reduce the allocations to bonds and stocks and reallocate into alternatives. So this is the emerging market right here. This is established and emerging. And investors that I talk to say, I want more of this because I can't handle the volatility over here. Interest rates are rising, stock market's extremely volatile. I can't handle another 70% drop in the stock market, especially when I'm getting towards retirement.
So that's the current situation, right? So do you think in future, like in 10, 20 years, it may be like 50-50 or something like that?
Could change, but this is the target. So the last piece, and how much time do I have? 3 minutes? Okay, last piece. So I won't be able to get to the capital budgeting, but I may do it next week anymore. You need to write this down too. You can also bow out the efficient frontier through the use of derivatives. Okay, through the use of derivatives. So by selling short, buying puts, writing calls, I can bow out the efficient frontier. By writing forward contracts and futures contracts, writing calls on futures contracts, and buying puts on futures contracts, I can also bow out the efficient frontier. So through the use of derivatives, it provides what is called portfolio insurance. It reduces the expected return because those contracts cost money, but it reduces the portfolio standard deviation significantly more than the reduction in the return, so the risk-adjusted rates of return go up. The last one, and then I'll end it, is you can also jump off the efficient frontier. I can jump off like this if I want to, through cash value life insurance. If all of a sudden I pass away and I have a $4 million life insurance policy on me, the portfolio that I've constructed for my heirs goes to them with an additional $4 million, be based on my life insurance. So the wealth effect, you can actually jump up and onto a higher utility curve, maybe not you, but your family, can jump off the efficient frontier onto a higher utility curve through the death benefit, through the cash value life insurance. There's no other asset class that does that.